Why is an IPO not a likely or optimal exit strategy for a founder? Hi, I'm Mike Lyon, founder and managing director at Vista Point Advisors. In this video, I'll discuss why an IPO may not be the best option for founder liquidity. Many founders think about an IPO as the ultimate high-profile exit. The reality is most SaaS businesses exit to a strategic acquirer or a private equity firm. An IPO can be a good fit for businesses that require large amounts of capital or are focused on building a consumer brand. Some considerations if you are contemplating an IPO. Scale. Generally, businesses have to be close to 100 million in revenue to be large enough to generate interest from institutional investors and investment banks that provide sell-side research. Alternatively, liquidity from private equity and strategic buyers can be available at 5 to 10 million in revenue. Delayed liquidity. When a company goes public, the initial capital raised is almost exclusively balance sheet capital, with only 20% of the proceeds for liquidity, and most of that liquidity is for investors and not founders. There's generally a lockup period after the IPO in which management can't sell shares for up to 6 months. Once the lockup period expires, founders can only sell a small portion of their shares at a time. It could take several years post-IPO for a founder to get meaningful liquidity. Short-term focus and costs. When a company goes public, the focus tends to shift from the long-term strategy to the short-term pressure of hitting quarterly earnings. The pressure to manage and deliver on short-term earnings targets can cause company to forgo investments, which can deteriorate company performance and valuation over longer time horizons. Furthermore, the costs involved in going public can be significant. For more information on this topic, take a look at the article our team put together, or feel free to reach out to one of our bankers at Vista Point. We're happy to help.